Hi guys, and welcome to yet another episode. This is Bifoni Sensei and this is the Candlestick Dojo. So in today's episode, I'm talking all about trading psychology. This is a very least spoken about subject in the trading space. Today I want to talk about trading psychology and the role of risk management in trading psychology. So we all know the saying that risk management, manage 1% of your account risk, 1% of your account per trade. But we all know that is not as easy as they make it look. Speaking practically as a trader, so risking 1% is vital for your survival in the markets. So trading psychology is a subject that affects most traders, me included. Trading psychology affects your performance because this psychology is the same psychology that is used in order to make good decisions in the market. So people talk about trading psychology and trading strategy. So strategy is the most important thing you must have. First, so for you to start talking about psychology and risk management, it is paramount for you to avoid the lockdown on the technical analysis and knowing your setups and the best time to execute your setups and the best times not to execute your setups. So trading psychology comes after you've already realized what you're doing in the market, you know what you're trading, but now you find that you can't use that wonderful information that you have. So this is very sad, as we all want to make money. That is why we're here, we can't lie. But for you to use this wonderful information that you have about trading and how to read the markets, read the charts, read chart patterns, analysis, you have to first have good trading psychology. Good trading psychology comes because things like fear, doubt, greed, these are psychological issues that affect the way you perceive your trades. So for example, you might have the best trades, the best analysis, but you find out that even though you have good analysis and good trade execution, you still lose on that trade. I don't think I'm the only one, but sometimes you might take a massive loss on that trade before the trade shoots up in your favor. This is very sad. I can relate to, because this shows that according to your strategy, you are good. You know what you're doing. You caught the move. You even caught the place where the move was starting from. But somehow you end up being stopped out of the trade before the market shoots in your favor. This is sad, because if sometimes you find yourself thinking, if I could have just taken a few more minutes and wait for this entry, maybe I wouldn't have taken these losses. But all well or good, that is all part of this journey, all part of this process. So today I want to tell you a few factors in risk management that affect how your trading psychology operates. So in order for you to avoid FOMO, avoid greed, avoid jumping into trades too early, so for most traders, analysis is not the problem. The problem is you find that you make so many mistakes over and over and over again, and these mistakes does affect how you perceive your trades and how you take these trades. So if you just you can find that I'm talking this sort of experience after tracking thousands of screenshots that I have of my trades. You find that if that trade you'd have taken it and placed better stops, you'd have made money. Or you find another trade that if you had waited a bit more for a better entry, you'll have saved yourself from losses. You find another trade that if you just followed part of your rules, you wouldn't have taken these losses. So I want to explain to you how risk management affects how these trades, how your psychology is affected in the trades. So first, risk management, we always say that you risk what you are willing to lose. So what you're willing to lose just refers to the amount that if you lose this amount, you will be comfortable. By comfortable, this means, of course, you'll feel the pain of losing that money. It is normal. You have to feel the pain of losing. But that pain must not get into your head. It must not affect the way you perceive these trades anymore, the way you take these opportunities, the way you perceive the next opportunity. Why? Because if I take a trade right now and it gets into my head, chances of me executing the next 3 trades perfectly or flawlessly becomes next to impossible. They become slim. So the first step is how you have to identify before you can fix these problems with risk management. No, the problems with FOMO and taking trades too early. First, you have to fix your risk management. So, in my opinion, in my own experience, I've found that if I take a trade that has a good executed trade, meets my systems, follows all my rules, and I just break one simple rule, I over leverage in that position, the chances of me trading that trade flawlessly drops significantly. What do I mean by drops significantly? It drops because I might see an opportunity, I take the trade, but if it reverses, the information telling me that this trade is not going in my favor anymore and I should close virtually disappears from my mind. How does it happen? Because for me to use the wonderful information that I have and take the best trades and the best entries, exits from a trade, I have to be thinking in my A game. I have to be in my A game at all times. So once you over leverage on a single position, the chances of you executing that trade with flaws increases drastically. Because if this trade, I'm in a trade right now, and I'm expecting the trade to engulf after my entry, and it doesn't, it engulfs but forms a shooting star. If I am not attached to this market and I'm not attached to the proceeds, that is, I risked what I'm willing to lose, the chances of me seeing this as an exit signal and getting out is high, because I am not attached to this one trade execution point. So if I am not attached to this one trade, the chances of me making the right decision and cutting my losses early increases drastically. But take the same scenario, but if this trade, I am all in on this trade, I've risked 90% of my account or 100% of my account. If this trade shoots a bit in my favor, I'm in so much profit. But the problem is these profits get into your head. The moment the market starts to reverse on you, the information that the market is reversing on you virtually disappears from your mind. That is how your mind plays tricks on you. These are called pain avoidance mechanism. Your mind is biologically wired to protect you from pain. What do I mean by this? If you see a trade that you took and it is reversing and turning into a loss, this is painful. Your mind doesn't want to perceive that opportunity, doesn't want to perceive that this trade might be a loser, because after analyzing and determining this is a good trade and risking all of your money on this trade, now common sense will virtually disappear from your mind. Common sense becomes so foreign to you. You won't see the head and shoulders pattern forming against you. You won't see the market reversing against you. You'll just be seeing the candles that are in favor to your position. So if you're taking a buy and the market is forming continuous selling and then forms one bullish candle, your mind is likely to hide all the red candles and just show you the bulls. So you narrow your perception to the thing, and this makes you lose on a significant trade. So for me, so I'm sharing opinions based on my own experience and how I was able to overcome a bit of these things. So the first and most important thing to your risk management, to your psychology, is your risk management. If I am willing to lose this amount of money, it makes it harder for my pain avoidance mechanism to kick in and take me out of a flow. So when you see the market and you are in sync with the market and you're risking appropriately, you can be able to use that wonderful information that you have about the market. But if you break your rules and start over leveraging on an idea, that information doesn't disappear from your mind. Get this right. It does not disappear from your mind. What happens is your mind hides all the information showing you that you're wrong. So even if you are the best analyst, you have the best market knowledge, this makes you're now unable to use your wonderful information on these trades. So if you're unable to use your wonderful information, regardless of what the information you have, what amount of market knowledge you have, there is no way of you trading this trade flawlessly. So you have to make, it is called, you're giving yourself the ample environment to trade effectively. Trading effectively means that you see what the market is saying from the market's perspective, and you're able to interpret it accurately without biasness, without fear, without FOMO, because you're seeing the market very objectively.